we've explored a number of factors which drive investment returns, but perhaps the most important of all is the human factor. Yes, we're talking about you. Even if you fully understand and accept that markets are efficient and that it's almost impossible to outguess them, you are only human. Rapid reflexes and pattern recognition are an important part of the process human beings use to evaluate and react to changes in our environment. Our prehistoric ancestors relied on them to stay alive, but in finance, where the coolest heads prevail, many of our base instincts cause more harm than good. For example, when markets tumble, your brain's amygdala floods your bloodstream with corticosterone. Fear clutches at your stomach, and every instinct shouts, "Sell." When markets soar, your brain's reflexive nucleus accumbens fires up within the nether regions of your frontal lobe. Greed grabs you by the collar, convincing you to hurry up and buy. Indeed, experts in what's called behavioral science have identified a whole range of insidious biases that can cause investors to act irrationally. Making you aware of these biases is another way in which an evidence-based advisor can help you achieve your investment goals. So let's have a look at 6 of the most common behavioral biases. Herd mentality is what happens to you when you see a market movement afoot and you decide to join the stampede. The herd may be hurtling toward what seems like a hot buying opportunity, or it may be fleeing a widely perceived risk. Either way, following the herd puts you on a dangerous path toward buying high, selling low, and incurring unnecessary expenses en route. Recency bias is the tendency to give recent information greater weight than the long-term evidence warrants. We know that stocks have historically delivered higher returns than bonds. Yet whenever stock markets dip downward, we typically see recency at play, as droves of investors sell their stocks. And of course, in a bull market, we see the opposite effect. Confirmation bias is the tendency to favor evidence that supports our beliefs and gloss over that which refutes it. For example, we're attracted to books or TV shows that support our belief structure. We'll skip over those that would require us to radically change our views if we are proven wrong. Of all the behavioral biases, confirmation bias may be the biggest reason why the rigorous, peer-reviewed approach becomes so critical to objective decision-making. Overconfidence is another behavioral bias that can seriously dent our returns. Research shows that most people, especially men, overestimate their investment skill. Such overconfidence tricks us into losing sight of the fact that investors cannot expect to outsmart the collective wisdom of the market consistently, especially after the costs involved. The flip side to overconfidence is what we call loss aversion. Loss-averse investors are more pained by the thought of losing wealth than they are excited by the prospect of gaining it. So, for instance, they'll prefer to sit in cash or bonds during bear markets. That's despite all the evidence that clearly demonstrates you're likely to end up with higher, long-term returns by at least staying invested in stocks, if not bulking up on them. Finally, investors have a terrible time admitting defeat. When we buy an investment and it sinks lower, we tell ourselves we don't want to sell until it's at least back to what we paid. But the evidence shows that this sort of sunken cost logic leads people to throw good money after bad. By refusing to let go of assets that no longer suit your portfolio's purposes, an otherwise solid investment strategy becomes clouded by emotional choices and debilitating distractions. So, there you have 6 key behavioral biases. But there are many more, and we'd urge you to take the time to study behavioral finance in more detail. Not only is it a fascinating field of inquiry, having a basic understanding of it will also help you become a more confident investor. And that concludes this 4-part video series. Thank you for watching.